Hey guys, so happy Easter. Um, I was supposed to do this video with some rabbit ears on, but I just couldn't bring myself to do it. I just couldn't. But what's an Easter without talking about credit ratings in the stock market, right? So, in this time where we are having a lot of volatility in the stock market, we're having a lot of money printing, uh, you know, a lot of businesses are at risk or becoming exposed, I guess you can say, uh, with interruptions in business and how sensitive they are to interruptions in business. So it's really important that we choose wisely uh, the stocks or investments that we make now, um, just because you know one little slip up and your stock pick can really you can a lot of the companies can go bankrupt. There's no doubt about it. And the lower credit rating that you have, the less cash on hand you have, and the less ability you have to raise cash, uh, will really uh, you'll really find out who has the strength in these times. So you don't hear a lot about credit ratings. I think the one I'm showing here is Moody's. They have S&P, and I think they have Fitch, but this one is Moody's. And one thing that credit ratings, as far as stocks are concerned, um, it just means how risky they are in the bond market. So a company can go out, issue a bond, and depending upon how likely they are, I mean, it's just like anybody going out to, if you were to go out and get a loan for a car, or a house, it's gonna depend on how creditworthy you are, on how much that loan is going to cost you, and it's the same thing with corporations. And so, like, we have credit scores through Experian and TransUnion. Uh, Corporations have credit ratings from Moody's, Fitch, S&P, things like that. So the way uh, corporations are handled is by a number system, except at least that's how Moody's does it. The other ones have different variations, but they're pretty much the same. And they fall from, if you look here, this top line here is investment grade, but it's from best to worst. So you have your best AAA rated um, investment grade company. Then you have your B2A3 investment grade still, but the lowest quality investment grade. And then after that, you go into non investment grade, which is BA1 down to C. BA1, when they say non investment grade, you'll also hear that referred to as junk bonds. Um, if you ever get down into the C's or just a straight up C, you'll see right here what all these mean. So a C is obligations rated C are the lowest rated class of bonds and are typically in default with little prospect for recovery of principal and interest. So if you go to AAA rated, obligations rated AAA are judged to be of the highest quality with minimal risk. So what you're going to want to look for, uh, I I think, is most important in this time, is a good credit rating. That means your stock has access to money, or has access to be able to borrow money if needed. That's one. Number two is cash on hand. Cash is extremely important. And number three would be the amount of debt, because you don't want to be highly indebted and still have to go tap the debt market, and you probably won't have as high of a credit rating. It would cost you more money. So one of my favorite stocks at the moment that I'm looking for is Cisco Systems, and that's ticker symbol CSCO. Now, I like to go into Seeking Alpha, and I like to look at, I'll show you the balance sheet. You probably can find a more up-to-date one, but this is close enough. Total cash, $27.06 billion of cash on hand. And then you look at their total debt, $17 billion of total debt. So they can literally take $17 billion in cash and pay off all their debt completely. And this isn't very common for a company to be able to pay off all their debt. So that's Cisco, and that's that's why I'm actually wanting to buy a whole bunch more of Cisco right now, is because they are in an extremely good position going forward. And how the credit ratings work, we'll look at Cisco Systems here and look at their credit rating. This is the Moody's website. You'll have to sign up for it, but I'm not going to go through a bunch of them. But if you look here, their long-term rating, this is what you want to look at real quick, is A1. You look over here, outlook is stable. And if you look over here, back over here, you look at A1, they have good credit. You know, A is obligations rated A are considered upper medium grade and are subject to low credit risk. Now, you know, there are companies that are trying to save their butt right now by accessing the bond market. And you know, it's getting very expensive. If we go over here and just for giggles, let's look at Carnival Corporation. And we'll look at Carnival Corporation as that loads. If it loads, there it goes. And we look at them, they are rated BAA3. So if we look at BAA3, they are still investment grade, but they are the lowest quality investment grade. So BAA is obligations rated BAA are subject to moderate credit risk. They are considered medium grade and as such may possess speculative characteristics. Now, the key is, though, if you look at the outlook, ratings under review. So they will probably get a downgrade, is my guess. You can go in here also and look at the debt list, and the one that I wanted to look at was the ones that they just issued March 31st with maturity of April 1st, 2023. So they have 3 years to pay this back. Pays an 11.5% yield, interest. So they borrowed, let's click on this right here. They borrowed 4,000 million. I believe that is $4 billion at 11.5% interest. Now they have this rating right here of BAA2, which is slightly above their credit rating of overall credit rating of BAA3. And the reason for that is right here is because it is secured. A lot of bonds are unsecured. These bonds are secured by the ships. So if they default, at least these bondholders, basically they sell off the ships and they can get, I don't know if they get all their money back, but they definitely can get some money back for sure. But the thing is, this is absolutely risky. They're on watch for a possible downgrade of that 4 billion, and that's not all they did. So that was just one piece of the debt that they took. So that is Carnival Corporation. I wanted to look at another one that actually has a lot of cash on hand, but they have a lot of debt, and that's Ford Motor Company. Ford Motor Company would probably be, let's see, BA2. See, they are in junk status, non-investment grade. BA2, obligations rated BA are judged to have speculative elements and are subject to substantial credit risk. And the outlook rating is under review. Their short-term rating is speculative. So, I encourage you. I'm starting to look at more of this stuff. I think it's quite important. It was important before, but a lot of times, when you especially, you get started in investing, you just think, oh, it's a good company because it's big, but when we start having these little issues, that not little issues, but when we start getting a big bump in the road like we're having, and things like this start coming to light and starting to really, really matter. So Ford Motor Company, could they get downgraded even further? They're already in junk status. We don't want to see them going a lot further down, but it's definitely, to me, if it's non-investment grade for a bondholder, I would say it's non-investment grade for a stockholder, in my opinion. And so with that, I have sold out all of my Ford holdings. And with Cisco, I am looking to increase my holdings because they are a strong company with a good credit rating. So if you want to own a company, check out their credit. Just like, if you were to buy a house, a bank is going to check your credit. You should be checking the stocks that you're going to buy's credit. So that's all I have today. Happy Easter. Eat a bunch of eggs. I don't even know what you do on Easter, to be honest with you. It was never my thing. Anyway, hope you guys have a good one. Stay safe. We'll talk to you later. Thanks. Bye-bye.